Hey capitalists, as of today, May 16th, the Jobs Act is in full effect. As you're probably aware, the Jobs Act's goal was to liberate private capital to get small businesses funded, but primarily get Americans back to work. Interestingly, a Fortune magazine article states that full implementation of the Jobs Act comes when America is at full employment, arguably. The Jobs Act created no new capital, nor did it provide incentives or disincentives for accredited investors to invest in private placements. Accredited investors invest for one of three reasons. One, to make a profit. Two, to shelter some sort of tax liability. Or three, to take part in a project that has some sort of social benefit. What the Jobs Act did at its core was allow for capital that already existed to be reallocated to an asset class. And it did this by focusing on three separate areas that any market needs in order to be successful. That's opportunity, awareness, and efficiency. An opportunity is a project where a business manager and an investor can come together to create value. When the Jobs Act started, there were plenty of projects out there, but investors and their capital were sitting on the sidelines. Where the Jobs Act hit its first home run was in an addition to Reg D that came in 506 as subsection C that allowed for these companies, these private investments, to be as loud as they wanted to be, to raise the awareness of their private placement. They could even post it up on Twitter if they wanted to. However, it was still limited, the investment was still limited to accredited investors. The final section, phase 3 of the Jobs Act that starts today, comes in form of Regulation CF, otherwise known as the funding portal. This creates a lot of transparency, or allows a private company to be as transparent as they want to be. They can still be as loud as they want to be about their investment, but what it does do is it lifts the restriction on accredited investors. So now non-accredited investors can go invest in private companies. You can essentially, now they can also do this through either an intermediary or an exchange or a funding portal. You can think of these as exchanges, as stock exchanges, and what this allows is for a market to be more efficient, more capital flowing in, more capital flowing out, because investors are able to sell their investments now and market the securities that they own. So what this means for a business owner is that, while they're still going to use Reg D private placements in order to raise larger amounts of capital, they might also want to look at either earlier stage rounds or an addition to this current offering by using a Reg CF offering.